Welcome, everyone. I'm Mike Mershazadeh.
And I'm Ashley Ward.
And you're listening to the What Matters podcast, and our mission
to spotlight top RIAs, wealth managers, and investment professionals who are redefining wealth management.
Join us as we dive into their journey, strategies, and insights.
Whether you're an investor or an inspiring pro, this is for you.
Get ready for impactful conversations on the What Matters podcast. Hey, everyone. Welcome to another exciting episode of the What Matters podcast. I'm your host, Mike Mershazadeh.
And I'm Ashley Ward.
And today, we're thrilled to have a special guest joining us, Michael Spector, the co-founder and CEO of Adero Partners based in Pleasanton, California.
From founding Adero in 1999 and having over 3 decades of experience in personal financing, Michael brings a wealth of knowledge and expertise to our discussion. Welcome to the show, Michael.
Oh, thank you for having me. 3 decades. Wow. Hearing that out loud is less than wonderful, but I'll just take it.
Well, we're excited to have you with us today. Let's jump right in and start by delving into your journey, Michael. Can you share with us your origin story and your journey from co-founding Adero back in 1999, and what experience have shaped your path up to that point and to where you are now?
Sure. I'll try and give you the abridged version. I started my career as a CPA and was at a small firm that had 2 partners and 3 or 4 staff doing tax planning and tax work in Palo Alto, California in the mid-90s. So it was right kind of at the bubbling of Internet 1.0, tech, everything. From there, I was a staff accountant. I became a partner, and my clients dragged me into this whole world of stock options. Everyone was granting non-quals and ISOs, and no one knew how to treat them from a tax standpoint, how to plan with them. So I had to learn, and goes right in the epicenter of it. So I developed a course on tax planning and taxation of stock options. And I would roll it out to companies that were private, about to go public, and put on a presentation to the rank and file employees, and then oftentimes meet with the founders and C-suite. And eventually, one of the partners from Goldman Sachs was at one of the presentations and kind of pulled me aside and said, "Hey, that was pretty good. That's one of the better ones I've heard. Would you mind presenting to our office?" And so in pretty short order, I was presenting to their office, and they started using me for all of they would underwrite companies in Silicon Valley, take them public, hand off those executives to their wealth team. The wealth team would call me up. We'd both pitch the clients. They'd get the wealth. I'd be doing the tax planning. From there, became a partner in our firm and ended up with an incredible stable of clients. Just some of the incredible minds that built some of the greatest Silicon Valley companies. And over the years, as we were doing tax planning and tax work, I would ask them the question, what's working and what's not? And they might say, what's not working is my investments. I don't understand them. It's not transparent. Take a look at this statement. I got a PhD from Stanford in math, and I don't understand my performance. So from there, it just wasn't transparent back then. You got gross performance, not net of fee performance. You got changing benchmarks potentially to make it look a little better. So I developed essentially a tool to help our clients see what their performance was. Net after fee, and then we did the tax return, so net after tax. And that was eye-opening. They started making decisions about where to move their money. They'd say, well, can you do it for my other 2 managers as well? And eventually I had a client, of course, much smarter than myself, say, hey, you're doing this for a bunch of clients. Can you just give me the answer? Which are the firms that are doing the best, that have high integrity, great performance, really take care of their clients? And I said yes, and that's when I started with what is now Adero. Was Vista Wealth Management, and it was to basically help bridge the gap for the clients. There was just a hole between what they were expecting, what they were getting, especially back at that time. Goldman was suggesting that they didn't want any clients that were under 25 million liquid, and they preferred them to be working. So there's a lot of clients underneath that for us to serve and provide tax, financial planning, tax returns and planning, and then make decisions around where we were going to place the assets with which firm. And that's how it started. It was just filling a hole where clients seemed to be underserved.
Really cool.
Fascinating.
So I had some questions about Adero.
Yeah.
You know, in starting the company, you guys have grown to what, over 3.5 billion AUM there. And correct me if I'm wrong. We only get public information, so feel free to correct me there.
It's about 3.8 or 9 now. We just closed a very significant client, which is helpful. But the markets move around, but somewhere in that 3.8, 3.9 range.
Wow. Can you tell us on your voyage on how you got there? Did you guys grow through organic growth, inorganic growth? How many total advisors do you have at Adero? We'd love to learn.
It's all the things. We did organic for quite a long time, and then I think we've closed 3 acquisitions over the years, and I think I looked the other day. Our annualized CAGR is about 24% annualized from inception.
Wow.
And so that's just a combination of market returns, organic growth, and M&A. The M&A pieces were never that big when you looking at the size we are today, relative to the size of the acquisitions we did. I think one was about 200 million of assets. Another one was about 300 million. And the last one was also in the maybe 180 million range. So when you add those 3 up, it doesn't seem like a huge component of the 3.8, but they were a while ago. So you get compounding and compounding.
Yeah.
And compounding. So there are about 18 advisors at Adero. We have more senior advisors and junior advisors. We have two advisors on every client, and very institutionalized firm. That's we've got great scale now, which is super helpful for onboarding. You can bring in a lot of revenue and clients without adding heads, without increasing rent, which are the 2 biggest costs for most of us. So two advisors on every client, and the thought is the junior advisor does a lot of the heavy lifting. We slowly bring them up. We give them roles in the meetings so that we can give them feedback until they're able to eventually drive meetings completely. And then the thought is eventually they will become the senior advisor, take over the relationship, and the more senior advisor will roll off and have capacity to take on some more clients.
That's really cool. And let me ask you this: and how many total teammates do you guys have at the company?
There are 53 currently. That includes a tax group of 5. So we are doing tax returns as well as tax planning for it's about maybe 1/10 of our clients right now. We're growing that slowly. There's huge demand for tax services. We could probably take on, I think we have demand for probably 50% of our clients would love to use what we call Adero Tax and kind of have that one-stop shop easy button, which is the direction I think most firms are going to have to go. And so we all have to, we've got to up our game. So that's part of the reason we started the tax group.
Do you guys think that will be a goal of yours at some point, is to have all those components in-house?
We really started that division to kind of deepen and widen the moat, frankly. It just makes clients stickier, and there's a lot of synergies working together with the wealth and the tax and understanding the overall holistic picture of gains and losses and tax efficiencies, and having everyone together around the table it's super helpful, efficient, and clients see the value. So yes, in a perfect world, it would be great if that was just the core service that every single client got to experience, but it's really hard. It's just a tough business because the hours are crazy. There's not enough tax CPAs available. And so you say, well, maybe you should go overseas, hire them overseas. Well, there's all kinds of disclosures you have to then have clients sign. Yeah. Are you okay with your data going over to India or wherever to be worked on? many clients say no.
Yeah.
So for 20, 30 years, there's been a shortage of kids graduating from colleges that want to become public accountants. And in places like the Bay Area, the problem is that you're competing with Google and Facebook or Google and Meta and Twitter and Tesla and all these companies. They all have finance and accounting arms, right? And the skill set that a CPA or accountant has that are very portable, transferable to all those jobs. So it's very competitive to get those people.
Yeah, we operated in my former business out of San Francisco and Walnut Creek for 14 or 15 years, and that was one of the main reasons why I moved to Scottsdale was to get talent, right? It seemed like everybody who I hired, I was constantly losing them to either a startup or one of the big guys. And so
I know your journey well. I know the pain. It's very difficult. Yeah.
So when in growing the company to the size that you've grown it, how do you guys bring clients through the door? I know you said you have the junior advisors. What's the method of marketing that you bring in? Is it word of mouth, or do the junior advisors reach out?
There's a variety of things that we use to fill the funnel. Mm-hmm. This year is the first year we actually hired an outsourced CMO, and we've allocated budget based on revenues to a full marketing budget. And so we're doing things like this wonderful podcast, and we're doing all kinds of articles, and we have a marketing calendar and schedule, and we have planned unique experiences with clients and prospects that will roll out throughout the year. So that is a new thing we're doing that we think at our size, it's now necessary to get the brand out there a little more. How we have traditionally filled the funnels, like everyone else, referrals are number one. So we train our staff on how and when to ask for referrals. There's training around that we do. We are also on the Schwab Advisor Network, so SAN, as all the other advisors know it. And as long as you are kind of doing well and performing, then you'll stay on that platform, and that kind of ebbs and flows. Myself and a few of the other teammates I have are what's, I don't know what the right way to say is. We're the kind of the big game hunters. We're able to just over the years, I got 2 or 3 people that, I just closed a $150 million client. It's a nice size client, right? I got 2 other advisors working on a $50 million client and a $40 million client. Now that's not our average. Our average is it's more in that 4 million sort of range, but we have some ability to kind of bring in we've always been able to bring in some large clients. So I guess, in the industry, we call it rainmaking. We got a couple rainmakers. And then, believe it or not, we have there's other firms out there, some very large ones that have very high minimums, 100 million and above, that have gotten to know us over the years, and they refer to us when they have prospects come in. So there's multiple avenues, right, that we use to build the funnel. Some years, the biggest is referrals. Some years, the biggest is SAM. Some years, the biggest is rainmaking. Some years, the biggest is institutional referrals from COIs and other firms.
Really cool. Thank you for sharing.
Yeah,
Sure.
That's fantastic. So with the amount of experience you have in this industry, I won't say the number again, but you've undoubtedly encountered various challenges and opportunities along the way, from starting your firm, building it to where it is now, and also doing a few acquisitions. What are some of the most valuable lessons that you've learned as an entrepreneur in the space?
There's a lot. I don't think we have time to go through all the lessons learned, but I'll share you a couple kind of core principles that I think have helped throughout the journey. One is, it seems so obvious, but our industry is terrible at it. Just in general, not RAAs as much, but don't get greedy. Just don't be greedy. You know, in our field, there are always those that kind of assent and get a little too greedy and get into trouble. And we see that repeat itself over and over again. Whether it's, people like the Madoff stories, right? There's always those stories every years of RIAs and wirehouse brokers and whatnot. So don't be greedy. Remember that you're a fiduciary, and that means not just to your clients, but to your staff. And so I think of myself as a fiduciary for the company, and the company really is the staff, right? The people I work with. So I've always been probably the loudest staff advocate. So many times I've had conversations with partners that feel very much like, what, am I like in the 50s or something? Like, this is, what are we talking about here? The reason we're going to do that benefit of, a month of sabbatical every 5 years is because Google and Meta are doing that, and all these other places, and we need to stay current in the market. And why wouldn't we do that if we can do that? So be generous with your employees. It will build incredible goodwill. So the number one asset I have is the employees. Trust me, I could never have built this company without the people that I have. Like, it is not me. It takes a village. And so I have an incredible village that I live in. And my job, I see it every year, is to make sure I re-sign my team, right? I get everyone back in the locker room. Stay humble. Don't be greedy. Be an advocate for your staff. Really listen. And I don't like hearing no. I like hearing yes. Yeses are way harder. No's are super easy and safe. And there's all these reasons why we cannot do this thing. Yes means you actually are going to take the risk and go for it and do it. So my journey has been me turning a lot of no's into yeses, and being a really strong advocate for our staff. And now many of them are partners now, and trying to, keep my feet on the ground.
Wow. Yeah. Very wise words there. And what advice would you give to aspiring entrepreneurs or wealth managers who are looking to build their own firm one day or enter into that space?
It's all about the people. You gotta, you need to know what you're good at, right? And then you need to make sure that you understand what you're not good at, and find those people. And it's not easy. It's really hard. But if you can do that, and you can create the magic of that, all the pieces snap into place, and you have that core team and all for one and one for all sort of thing, super powerful, and you can do amazing things.
So have you always been the CEO of your company? I know
Yes.
you're the founder, but
Yeah. I have some really great partners, like really great, that have been with me, 20 years,
Wow.
And they're younger, they're smart, they're great. There's a couple times I've said, hey, maybe it's time to transition to a new CEO. I'm not going anywhere. I'm good. I love my clients. I love the staff. I love doing what I do. But maybe it's time for someone else to try on the hat, and it'll be different. It'll feel different, but it might be great.
Mm-hmm.
And so no one really wants to do it. They like the way it is right now, so they say. Although it's hard to tell the boss or the CEO that they don't and they want. But so I don't know. I think there's no doubt at some point someone will be the CEO, and I will support that, and be very excited to help them however I can.
And how many other partners are at the organization? Well, obviously besides yourself there.
There are 9 partners now. So we have every year we do a valuation of the firm. Well, I guess let me take a step back. How do you even become a partner? So when I went back, I was talking about institutionalizing the practice. Every single job has a career path, and advisors have a career path to partnership. And so every year there's basically a board, an executive committee, if you will, and they nominate someone for partnership if they meet the criteria based on the career pathing. And if they do, then there's an offer made to join the partnership, the partner group. And if they accept, we haven't had someone not accept yet. They do a 1-year tour of basically coming to the partner meetings, hearing the dynamic, hearing the issues, hearing how things are discussed and resolved. And at the end of that year, if they decide, they're asked, okay, you've seen it, how the sausage is made. Do you want to be part of this? If they say yes, then the financial terms are all laid out for them, and then on January 1, they become a partner.
I think that's great. I think it's great to tie in, a lot of your talent. It certainly, you tie, and once they're tied in, and they've been at your organization for, quite some time, and they feel like it's, and well, not feel like it's a piece of theirs as well, right?
It's no small commitment to decide to join the partnership group, and thankfully, we're making new partners. And then every year, what I was saying earlier is every year there's a valuation done that takes the value of the firm and and basically says it's this much per unit, and those units can be fractionalized. And then there's an offer: does anyone want to buy or sell? And this year we had 3 buyers.
Real cool.
It was 3 of the newer partners that were partners in the last year or two. The valuation went up something like 30% from the prior year. But they're like, long-term value, we think this thing is doubling, tripling, or whatever, so we're buying in now. And these are not small checks. This is like their savings. The firm has not set up financing yet. We'd love to when interest rates come back down a little bit. But at some point, that will be a vehicle that will help to facilitate equity transfers. The other important thing we do is between the ages of 65 and 70, you have to sell out of all your equity.
Really?
You cannot. It doesn't mean you can't be at the firm after 70 if you want to be, and the partnership agrees that they want you just to work there. But you will transition out of the partnership group into the operating company, because we do not want older partners just sitting there holding all the equity. Mm-hmm. Right? Well, all the younger partners are working. They can't buy the equity because older partners are sitting there saying, no, I'm just going to wait. You guys are doing a great job. Keep building away. I love how my value's going up every year.
Right.
It's not a great incentive for younger partners. So these are the sorts of things that we think about. We're in a privileged place that we get to think about these things and set up these institutionalized sort of business structures. I will tell that the young entrepreneur wealth management, breakaway broker that wants to get into the RIA space, it's an incredible business. It really is. Serving clients is very values driven. It feels great when clients say, thank you for this. You made me sleep better at night, or whatever the thing is. You helped me with mom or with dad. The hardest part is that just attracting the talent when you're small. That is the most difficult thing. And the most important thing about what I just talked about with the career pathing to partnership and having actual partners is the ability to show these potential employees, see, it's just not me. We have actually made other partners. We've made other careers. This is a place where you can make a career, become a partner, have all your dreams come true. When you're small, and it's just your name on the door, right? And you've never made another partner. And you're trying to hire the best and the brightest. It's very hard for them to see, well, how am I going to become a partner when you never made another partner? When does that happen? How does that happen? And so, what I tell myself 20 something years ago is to learn how to figure out what we've figured out now earlier is the career pathing. It's very important to all your potential employees out there. They really want to understand more than ever, how do I get from this position to that position to that position? What are the metrics I need? What will the compensation be? What is the timeline? It didn't used to be that way when I started my career. I was told to just put in more hours than anyone and hopefully I'd still have a job. But that's just not how it is in today's work environment.
So, looking forward, what do you see for the future of Adero? What are your guys' 3 to 5 year goal? And
there's some big things happening actually. I think we're about to start what's called a MFO practice, a managed family office practice. We have a gentleman that's going to be joining us. It's going to bring some significant clients and revenue and assets over to kind of lead our managed family office practice. That's a practice in which you act as the family CFO for typically very large clients, billion plus clients. And you may or may not be managing any of their AUM, but you are basically taking on a CFO, maybe even CEO role, putting in place their state attorney, maybe their corporate attorneys, their taxes, their bill pay, their account, their quarterly accounting, whatever businesses they have, all the real estate, and you're rolling it all up on a quarterly basis or monthly basis and reporting to the stakeholders in the family. This is how all the things in the family are doing, and you're helping to deploy the assets to different places. So it's something that we have experience doing for many of our large clients. But the difference is we've always managed the investments as well. This is a new service offering where you don't need to manage the investments. You can just charge a fee. These clients are so large that the fee is significant. But it is a unique person that fits into that division. They kind of need to be quite experienced and a journeyman. They have to understand estate taxes, tax planning, corporate structures, investing, all the things. And there's not a lot of those people out there, but there are some.
Thank you.
Very exciting. And what do you envision for the future of wealth management? Any trends, technologies, strategies? You mentioned, an MFO office. You see that potentially more firms doing, like opening that. Any other technology or trends that you think that will really be shaping the future?
I guess this is the time we mentioned Jensen Huang of NVIDIA. They're doing, I think, the NVIDIA conference right now. It's amazing. He's added, I think, $1 trillion of market cap this year to his company.
Yeah.
People don't realize that company's 30 years old. So
yeah.
Started in 2003. So shout out to Jensen. I think AI is going to be huge for wealth management. And I'm really hopeful it's helpful. And I think it has the potential I could form a narrative where you have all AI advisors and all the things, and the humans aren't necessarily needed. I don't really think that's where we're going anytime in the near term. But I think AI will just be a force multiplier for our staff. So I think there's going to be tools that are created that are going to help staff with training, help staff to access data and do things far more efficiently. And that could be anything from, as I said, training to trading. There's so many areas. I have one of my close friends is actually running a big part of OpenAI. He's at Microsoft, and he's helping to run a big part of the OpenAI project from Microsoft.
Hmm.
I think he has 800 engineers under him working on this exact project. And we were talking about indications for wealth management just the other day. And, so they're already thinking about what are the tools that they can create for our industry. So I expect to see some within 12 months, likely, that will be available to us.
That'll be very interesting to see what comes of that. Definitely agree with it, just optimizing efficiencies. Do I think it's going to take away the complete human? No. Everyone's going to still want that human-centric, that human touch, but definitely will be interesting to see. Let's talk about it. Investments. What investments and sectors excite you the most right now? Any light on investments for the next wave of wealth creation, possibly?
Well, wealth creation. Our clients tend to have already created their wealth, and our job is to kind of protect it and to keep it growing, to achieve their goals and their needs. I think real wealth creation typically comes from big risk, so it's single stocks. It's going all in on Bitcoin when it was at whatever it was. It's literally, you want to create the people I know that have the most. Elon Musk, he almost went bankrupt 2 or 3 times. He took all the money he got out of PayPal, invested it all into Tesla and SpaceX. So I think wealth creation is about betting on yourself or getting a big bet right. In the RIA space, we're typically about wealth protection. And so for us, that means diversification. And for our clients, about a third of their investments are going to be in non-public alternative investments that are going to include multifamily real estate. It's going to include private equity, which will have venture, middle stage, late stage private equity. It's going to include alternative credit solutions. A third will be in public equities. Some more heavily tilted towards the U.S., but some allocation to foreign developed and emerging. And then we're going to have a fixed income component for most clients, and that's a combination of that just is very client centric. It could be various muni ladders or T-bills or corporates, or even interval funds. Just depends on their situation and their kind of cash flow needs. I'm not sure if that's a question or not.
No, I think that fixed income is, is finally paying, right?
That's right.
So, I've actually recently diversified, more into fixed income. I think I'm 61% equities and 49% or 39%, 53 and 47% into treasuries now. So, before when you were getting, 1% a year, or 1.2 or 2, even 2%, I think it was. I'm not sure. It was so low. It was just, you wouldn't even see the reflection on your, in your portfolio. But so Michael, highlighting on that, what do you, in speaking of fixed income, what do you see as the economic outlook? We've taken on so much debt. Interest rates have fluctuated so much over the last, 3 or 4 years. What's your economic outlook? What do you think is going to take place over the next several years, especially with the election coming up?
I mean, I wish I could grab my little crystal ball here. Here it goes. I think most people think interest rates are going to move down a bit for a while. I don't think we're going back to zero. I think we're going to go, probably below 4% on the 10-year. I don't know how low it goes. I'd love to see something, between 3 and 3.5. That would be wonderful. It would really help the housing industry. I think, in terms of markets and fixed income and public markets, I don't have anything on the horizon that makes me think there's anything dramatic other than, 10% annualized returns for equities over the long term. and it's going to go up and down and up and down, and it goes up and to the right more than it doesn't. So
Yeah.
in terms of equities there for the economy, all indications of the economy is strong and doing well. A lot of people that, the middle class and lower class that are all maxed out on credit cards because, the interest rates are so high now, and they're feeling the hit of that. That's problematic for them, but they're not the ones that are the biggest consumers spending the most money. I hear a lot about people concerned about the debt levels, the U.S. debt levels. The majority of that debt was taken when interest rates were at 1% and 2%.
Mm-hmm.
So it's something like $35 trillion of debt, I think, something like that. So a huge percentage of that is at a very, very low interest rate. And
Oh
there have
God,
been
you're saying the amount of money that we borrowed was at such a low interest rate. You don't see it quite affecting us, the
I
economy.
just don't see the use case of how that affects our economy. And it's basically, okay, our interest payments are going to be so large that we're not going to be able to afford, whatever it is. You name the thing that our budget is for. We're not going to be able to start affording that. So we're going to have to print more money. We're going to be in this death spiral because we're going to be printing more money at a higher interest rate, and it's going to take up more of the budget. I think I heard some stat that our debt to GDP relative, I think Japan's debt to GDP is 4 or 5x what ours is, and has been for a very long time. So they're still around.
Yeah,
The stock market is actually having a good year. They're doing well this year. So the real fear than what the other side says is people aren't going to use the dollar as the reserve currency. It's going to be a huge problem. And no one's going to buy our money because we're just printing it so cheap. I just don't see it. No way. Where are you going to go? What's the reserve currency going to be? Is it going to be Bitcoin? You can't transact in it currently. Is it going to be the ruble? Is it going to be some controlled dictator's currency where they can do whatever they want with it? I don't think so. Is it going to be something in South America? No way. I'm telling you, you go to any country, and you ask them if they want to transact in their currency or you got US dollars.
and they'll take US dollars any day.
Right.
They're all taking US dollars. That is not changing anytime soon. And so because of that, it kind of doesn't matter what our debt is. I know that's shocking, but I just don't see that having an impact on our economy because we're 330 million people out of 8 billion, and we have something like, our market cap of our markets is 60% of the world.
Right.
So we're kind of in this perfect spot. I know a lot of people feel like we're not, but when it comes to currency and economic power, we're in a good spot, and I don't see anything really terrible coming. The only caveat I have is there's a huge problem in commercial real estate.
Yeah. Yeah.
And that has got to get resolved. And I don't know. I have friends that are raising funds to basically buy up all the properties in San Francisco, for example.
I was just going to say that San Francisco market's gotten beaten up so bad. I think it would be a great time to buy there.
So people are buying kind of marquee locations for just the land value. Okay. So you got a huge building, used to be valued, a couple $100 million, and now they're valuing it just for dirt. And
30 or 40 million.
And I said to him, well, yeah, because it still has this building on it, and you're still going to have to pay property taxes and whatever you have to pay for, I don't know, a decade of carrying costs before you can, I don't know, bank on that property coming back or whatever. That said, there's a reckoning there to come, right? I hear that Miami's been massively overbuilt for luxury condos. Like the only way that works out is if every millionaire on the planet buys one or two of them in Miami, which of course is not going to happen. Austin, where I am, is definitely, we got a bunch of beautiful commercial buildings that are that are empty. So there's a lot of commercial space that was built for the big boom, and we are still getting net positive population growth, but it's going to take a while. So that's a piece that's a little concerning. I don't think it's enough to bring the whole economy down, but if you're in that area of commercial real estate and you're a broker trying to, sign leases for commercial tenants, that's a tough gig.
Yeah.
And all the trickle down of all the people that used to sell all the services, or all the people that were in all the offices, all those restaurants and the dry cleaners and all those people, that whole ecosystem has been disrupted. And I don't know, it will resolve in some way or another. And it is resolving slowly.
Yeah. No, I appreciate you saying that. You're probably the only person that's ever brought up the fact that we borrowed this money on such low interest. I appreciate that insight. I hadn't thought about that.
Well, and that our currency, I mean, we're the most stable currency. Where else are you going to go? Like, I mean, you name a country that you are going to swap our currency for theirs.
Right.
Yeah.
I mean, the euro is had all kinds of problems. I mean, now you got the British pound. I mean, that's also got problems. I mean, you go over to Europe, they want US dollars.
Mm-hmm. Yeah. Well,
Yeah.
thank you. I really appreciate your insights there, Michael.
I think that's, the perfect thought-provoking comment. We'll leave the conversation off for today. Let our listeners kind of think about that for the rest of their day. But thank you so much for joining us today, Michael, and sharing your invaluable insights and expertise with us. It's been such a pleasure having you on the show, and I really appreciate your passion and your honesty towards your thoughts here. So thank you so much for taking the time to join us today.
Thanks, guys. I enjoyed it.
And that wraps us up for another episode of the What Matters podcast. Join us next time for more enriching conversations on finance and wealth management.